Kelly and I have known each other for a long time. She's a longtime business partner and a great friend. And Kelly, would you like to introduce yourself?
Sure. Hi, everybody. I'm Kelly Clawson. I've been with Polaris for 16 years, and I am the Director of Financial Services. What that encompasses at Polaris is our retail finance business, as well as our financial products business, where our extended warranties fall under, and then our corporate risk and insurance. And today I'm excited to talk to you about the extended service contracts, where I've been lucky enough to work with Paul and the After team. Thank you for inviting me today, Paul.
Nice to have you here. And I just want to show one quick slide about that shows some of our clients. It's a partial client list, and we wanted you to see that we've got experience across several sectors in the work that we're about to discuss. And so that experience, I think, can provide some additional insights that we're happy to share. I also want to share a little disclaimer for some of the eye charts that you're about to see. You know, it's kind of interesting. We had two choices for this presentation. One is to use a few rather cryptic bullets on each slide and speak to them, or to provide more details on each slide so it would be more meaningful. If you look at a copy of the deck later or share it with others, we chose door number 2. And so some of these slides will have quite a bit of information on them, but that is by design to hopefully make it more meaningful for you as you go in and grab a copy of it and watch the video and so on. So real quickly, much of the information that we're going to discuss today is centered on extended service contracts or extended service plans. But please keep in mind that the quantitative methods and the case study are directly applicable to both extended service plans and limited or manufacturer's warranty. So kind of keep that in mind, if you would, as we go through this. We have found in our experience that the risk management and accurate forecasting is one of the least understood but most impactful aspects of extended and limited warranty program design. And at the very foundation of that are accurate CPU or cost per unit forecasts. When they're accurate, you end up with stable prices and program management. You end up with right-sized reserves, higher profits, and higher customer satisfaction and loyalty. In our experience, with one exception, and I'll discuss that in a little bit, we find significant errors in the CPU calculations. And one of the reasons for that is because the CPU forecasts are generally produced by using antiquated quantitative methods. And in fact, these methods go back to the 50s and 60s. And they work well if the historical data is a direct predictor of what's going to happen in the future. But that doesn't describe a lot of the sectors in which we deal, because we've got, as you know, every one of you are dealing in sectors where you've got changes in technology, changes in product mix, changes in consumer behavior, new platforms, new products, and so on. And that renders the historical perspective, the data, is somewhat less useful, and you need to be really careful in deciding how to use that. And so if you find that your analysts are relying solely on loss triangles or chain ladder, augmented chain ladder, Weibull, Cox regression, similar methods, there's almost certainly room for improved CPU forecasts. So we're going to cover 4 topics today: key components, risk structure review, how to do accurate CPU forecasts, and then the Polaris case study. Now, Kelly asked me to kind of spend the time in the first 3 sections and in setting up the case study, and then she'll come in midway through part number 4, topic number 4, and really kind of share what happened with Polaris and the changes that she went through and how she used the information to really set a new risk roadmap for Polaris and how they did it. And she's just done an outstanding job with that. So part 1, we've got 2 slides on risk management definitions, just to make sure we're all on the same page. So if you take a look at this, premium is defined as, it can include multiple fees and a different math. We kind of refer to it as insurance math. It's different, but it's not wrong. It's correct, but it's different from what we think of as typical math, and we'll show you some examples of that. Cost per unit, or CPU, are very simply the dollars needed to cover parts and labor, and oftentimes claim administration. This is the key. Because the CPU drives pricing, term offerings, age limits, and everything. A safety margin is a percent added to the CPU to cover changes or unknowns, because things happen. As new platforms are developed, new technologies put into place, new products, and so on, things can happen. And then engineering takes over, engineers any issues out, but we need a safety margin to absorb those sorts of things. Now, using insurance math, which is correct, a 15% safety margin adds $17.65 to every $100 of CPU. And don't worry, we'll explain and show you a chart. Now, a risk fee, think of that as the base wage for a carrier. If you're using a carrier to underwrite the risk, that is their fee that's needed to cover their resources, deployment of capital and surplus, and so on. A 10% risk fee, in this example, would add $13.07 to the $100 CPU, and that's on top of the 15% safety margin. Premium tax, which is charged by the state to the carrier, depending on where the carrier is domiciled. 2% premium tax is plus or minus is kind of typical. That would add $2.67 to the $100 CPU. So now we're sitting at $133.39 on top of the $100. There's investment income, and I want to get this definition out there, because there is premium that builds that is not earned. It's not, you don't pay the claims immediately. They're paid across the term of the liability. That premium could be invested in limited ways according to guidelines during the term of the liability. So where does the investment income go? Typically, it will seed back to the loss fund, but not always. And so it's good to know about it. We're almost done. Last page of definitions. Loss fund, it's the amount left to pay the claims after the risk fee, the premium insurance tax, and so on. So it's typically equal to the cost per unit plus the safety margin, and maybe plus some investment income. Underwriting profits are the money left over in the loss fund after the liability is earned. So in a perfect world, it would equal a safety margin plus investment income. Now, profit share is the percent of underwriting profits that you might receive. So think of those underwriting profits listed above. It can include all or a portion of the underwriting profits, generally 50 to 100%, depending on the size of the program, the known risk, and so on. And sometimes it's not as high as 50%, sometimes it's lower. Premium earning patterns, that's the percent of premium earned each month. It's often earned pro rata by those doing the work pro rata. That can be a huge mistake, and that's where we find a lot of the errors, and we'll explain. Claim emergence patterns, or the percent of claims that occur each month. As we mentioned just a moment ago, it's seldom pro rata. The loss ratio is typically calculated as incurred claims, or the claims that have been incurred up to the analyst date, divided by earned premium, or the amount of premium that's earned through that date. Major errors occur as a result of earned premium issue. And we believe that the right calculation is total forecasted claims over total premium. They're not the same, they're not equivalent, and that's where we find a lot of the errors. Any questions so far before we get into part two? Okay, I'm going to assume we're good to go. We put together kind of a continuum, or what we refer to as a risk roadmap. And one of the things I want to do is make sure that you understand that we've really simplified this. there are hybrids available throughout all this. And in fact, Kelly used some of the hybrids along the way. But let's use this as an example for a moment and say when you look at the lower left, we're saying the highest cost, lowest control. And when we refer to cost, we're really talking primarily about risk transfer costs in this case. So the carrier risk fee, the safety margins, premium insurance tax, underwriting profits, additional carrier margins, and so on. And higher costs result in higher retail pricing, and it has a multiplicative effect, and we'll show you that. On the right-hand side of the continuum, we go lowest cost, highest control, and when we're referring to control, we're talking about control over the program elements like pricing, premium, and rates, feature benefit changes of any program, be it a service contract or limited warranty, the timing of the changes, the cost of risk transfer, claim administration, and so on. And again, we've simplified this, but as we kind of move through this continuum, it's important to keep track of the idea of, I want to know more about my risk than anyone, and then I'm in the driver's seat to structure the risk in the way that I want, that gives me the kind of control that I want, that either keeps it on or off my balance sheet in the way that I want, but gives me the control that I need. And so there are several hybrids available. For example, we often set up service contract programs with what we refer to as a dealer cost, but we also include a profit share and complete transparency and advanced analytics that drive the CPU forecasts and the loss ratio. But that's not normally what we see in the market. And so we wanted to kind of share this the way that we normally see it in the market. So you realize kind of what is normally done and what the structures normally are, but keeping in mind that there are a lot of different ways to do this, including the way that I just demonstrated that we do it. So dealer cost, you can think of that as $1 insurance. In this, there may be no participation with the retailer or the manufacturer. You take your dealer cost, you mark it up, and you sell it. Profit share agreement, the carrier and the manufacturer, retailer, or TPA share in the risk and underwriting profits. The risk fee and the premium insurance tax are not part of the profit share agreement. They, remember that's the insurance carrier's income, and the premium insurance tax goes to the state or country in which they're domiciled. The carrier needs minimum income from smaller programs, so sometimes that comes into play. The safety margin may or may not be a part of the profit share agreement, but normally it's included. And investment income on unearned premium typically cedes to the loss fund, but not always. Normally you'd have periodic rate reviews. There's always a holdback for runoff. So let's say you had a program, you stopped doing business with this carrier. They're normally going to hold back a share of the profits until the program completely runs off as added protection for them, which is appropriate. It's also designed for the program size, market competitiveness, and fairness to all parties long-term. Another piece of this is the administration fund. Who holds it? The carrier is ultimately responsible if the unforeseen happens, but oftentimes the administration fund can be held off the books of the carrier, even under $1 insurance, and we can explain that at a later time. You got a captive model. It's not just for large programs any longer, and captive is certainly one of the things that Kelly will talk about. And then you've got self-insured. Several companies carry their own risk and earn their income over the lengths of the contracts. A little bit of additional description and some pros and cons of each. We've described dealer cost. The pros are it's a simple structure. It transfers the risk and it's off the books of the selling entity. You can recognize all the revenue when the contracts are sold. You have the positive marketing spin of a program backed by a highly rated carrier. And it can be a really good structure for brand new programs or programs where there's little claim information available. But be sure to not make one of the mistakes that we see in the industry oftentimes, and that is no matter how you set it up, never give away your claim information. Always make sure that you are contractually that whoever you do business with is contractually required to provide all the detailed claim information back to you, because if you don't, your ability to change structures or understand the business in the future is hampered until you can put your hands on that data. This may also be a good place to start if you don't know what you don't know. The cons: you're surrendering some cash. You may have no visibility into the claims data, limited flexibility on pricing. The carrier can change rates at their discretion according to the contractual agreement, because you may have no real insight into the underwriting performance. Under this type of structure, there is typically no underwriting profit share. And the surveys consistently demonstrate that the consumer preference for manufacturer and retailer-backed programs, but there are other ways to do that. We can talk about that. So keep in mind that when we talk dealer cost, if you remember just a few moments ago, I stated that there are hybrids. And so we typically will stand up a brand new program on a dealer cost with profit share, with transparency, with advanced analytics. The profit share, we define that. By the way, the claim administration may reside with the manufacturer or retailer, but the insurer controls the approval. And it's very typical for an insurance carrier to go ahead and approve a retailer or a manufacturer to administer their own claims. They may do a claim audit to make sure that the system and checks and balances are in place, but it's very typical for them to approve the manufacturer or retailer to manage their own claims and adjudicate their own claims. The amount and timing of the profit share is negotiable depending on several variables, including what you know and what you don't know. Some of the pros, the profit shares can be huge. I mean, millions of dollars, depending on the size of the program. Hopefully you have more transparency into claim patterns and the resulting rates. The risk it's still off your books, or it can be off your books. And so you can recognize all the revenue when the contracts are sold, and you still have that positive marketing spin of being backed by a highly rated carrier. The cons can be, and this is what we find, the actuarial analysis is often significantly flawed, and that can lead to higher rates, higher costs, and higher pricing than is necessary. Another con is typically smaller programs that are less than 1 to 2 million of annual premium are often not eligible for profit share arrangements. And without cutting edge risk oversight, the manufacturer retailer may not understand the hidden optimization opportunities that exist. Let's move over to captive. This is really kind of an interesting one, and it's being used a lot in automotive, and it's moving over to some other sectors too. And for large programs, this can work out really well. But keep in mind that extended warranty programs are a good way to diversify a captive portfolio, but they're often not something that creates enough advantages on its own to create a captive for its own sake. That may or may not be true. It depends on the situation, but keep that in mind. The pros are that the coverage can be, tailored to meet specific needs in the risk profile. There are tax advantages. There are lower risk transfer costs if it's fronted by a carrier, where a carrier writes a contractual liability insurance policy or CLIP. If it's fronted by a carrier, the risk fees associated with that are much lower, and you can still immediately recognize the income. And you have more control over your program elements, and you retain 100% of the underwriting profits and investment income on an unearned premium. A couple of cons, and it's a more complex structure. It requires insurance or legal and compliance expertise. If you front it by a carrier, the carrier often provides guidance in those areas, and it does require really the new age analytic and modeling capabilities, but that ends up being a pro anyway, because you need that. Now, one of the things I did is I put the Hawaii Captive Insurance Council down here because Kelly, when they created a captive, Kelly made sure that they use a captive that is domiciled and managed out of Hawaii. And she has managed to structure all of her visits during the winter. And Polaris is headquartered in Minneapolis. I just think that is smart management. And Kelly, I don't know if you have any comments on that, but I think that was a brilliant move.
No, it honestly was not my idea. So I can't take any credit for it. And it just so happens that their annual conference is in October. So pretty much all the captive owners.
And I still think it was a great move. So let's take a look at self-insured. That's where a manufacturer retailer sets aside a certain amount of money internally to cover the claims. Generally speaking, an insurance carrier is only used if required by various regulatory bodies, and Kelly will speak to that. It's a simpler structure. You have control of your cash. There's a lot more flexibility on pricing, features and benefits, and timing and so on, lower costs, higher margins. The cons can be, depending on how you structure it, that you retain the risk and it's on your balance sheet, maybe, depending again on how you structure it. Potential compliance risk, but that is certainly manageable. May not be a core competency. I will suggest that when Kelly went out on her risk journey, that wasn't a core competency, but it sure became one, and she'll talk about that. And if there's not carrier involvement, the income may be deferred over the life of the contract, depending on how you structure it. Now, remember, these aren't boxed structures. They're the hybrids that we talked about, but that kind of helps us understand what the continuum can look like and maybe what some of the options are in between. So part 3 is the importance of accurate cost per unit forecasting and the impact on reserves and retail, and the retail price. So think of the cost per unit, if you would, as the fundamental variable for reserve management and retail price. And we're going to do a couple of examples and show you what happens. So total reserves, the dollars held by the manufacturer or retailer to cover claims, or the premiums paid to an insurance carrier when you transfer the risk. So keep that in mind, if you would. Now let's look at retail price, or RP. That's the amount charged to a consumer by the manufacturer retailer, the selling entity, for an extended warranty or service contract. And it could also be the amount that a manufacturer holds in reserve, if you will, to pay limited warranty claims. So similar to most retail price calculations, the warranty retail price is the sum of the wholesale price, which are the total reserves in our example, plus the selling margin. Now, in our example, we're going to show a typical 100% markup from cost. Not everyone and not all sectors do 100% markup or a 50% margin, but many do. So we're going to go ahead and use that. So in the bottom section, you'll see the total reserve is equal to the cost per unit plus the admin fee, plus the safety margin, plus the risk fee, plus the premium insurance tax. And the retail price is equal to the total reserve plus the selling margin. Now you got to bear with me because we're going to do a couple of eye charts, but you'll soon see why we included all the information. So get out your glasses and here we go. So assume for a second a lawn and garden manufacturer and you sell riding mowers. The retail cost of your mower is $2,000 and the cost to repair the mower for a 4-year extended warranty term, therefore the cost per unit, is $100. So then we'll come over here and we'll look at the assumptions on the top of this chart. So the accurate cost per unit is $100. Let's assume for a moment that it costs $30 per claim to administer a claim. And that's all in, taking the phone calls, the system work, and all those good things. Let's say the claim frequency is 10%. And for example purposes, that just means that 10% of the contracts will have one claim. It's a lot more complicated than that, but for this will work for this example. The safety margin, 15%, which is kind of typical. Some are higher, some are a little lower. Risk fee of 10%. That could be a little on the high side or it could be dead on. Sometimes it's higher than that. Premium insurance tax, 2%. Let's say the selling margin is 50%. So now let's go down to the equation. So let's do the build. We've got $100, which is the accurate cost per unit. We add the admin per contract, and that's $30 admin fee times 10% claim frequency. So we're adding $3. So now we're up to $103. Now we add a 15% safety margin. The insurance math, which is again correct, takes that 103, divides it by 0.85, and that adds $18.18. So now we're up to $121.18. Now we add a 10% risk fee. So we take that $121.18, divide it by 0.9. That adds $13.46. So now we're up to $134.64. Add the 2% premium insurance tax, take that you take the 121 and divide it by 0.98. And that gives you, now we're at 137.39. You add the selling margin, now we're up to $274.78. So for $100 in claims, assuming we're accurate with our cost per unit, the consumer is now going to pay almost $275 with a 50% margin. And you know, the selling entity may not require that type of markup, but many do. And there are a lot of reasons that the consumers purchase an extended warranty contract that make it a good decision. But now watch what happens if our cost per unit is inaccurate. Let's take the same example, but assume that the CPU forecast is wrong. It's $35 too high. It doesn't sound like too much. Well, let's see what happens. Same assumptions, except now instead of $100 CPU, it's $135. I'm not going to walk through each of the steps again, but you can see what happens. Instead of a retail of $274.78, we're now at almost $370. Instead of a total reserve of a little over $137, we're at $184. And so what happens in a situation like this, and this is why we really key on cost per unit, because if we're wrong there, we're really wrong everywhere. And it can work both ways. Most of the time we see, and we'll share a few examples in a moment, most of the errors we see are in this direction. And so in this case, we were only wrong by $35, but it almost tripled at retail just by one little mistake that then gets multiplied. And so here are the impacts. If it's overstated, if CPU is overstated, then we see what we just saw, where the mistake was almost tripled by the time we got to retail price. Then total reserves are inflated and cash flows that could be used elsewhere in your business sit idle in the fund. And if you're transferring risk to an insurer, here's what happens. You've got to pass that cost through to the consumer. And so it may hurt your ability to sell the service contracts. It may raise the price of your products in the market if you're talking limited warranty. And in a case like this, if it's a service contract business and you raise the premium from 137 to 184, which is, if I remember correctly, about a 35% increase, that could really be catastrophic to your warranty program and could cause huge issues. The opposite occurs if the CPU is understated, because then you set aside less in total reserves, or the insurer gets less in premium to cover the claims cost. The business, when it's discovered, will be forced to raise cash to cover its obligations or to try and raise prices prospectively, which often doesn't work well. And we'll talk about that in a moment too. An understated CPU will also lead to a lower retail price, and that'll drive sales demand in the short term, but it's going to cause major damage when it's discovered. We've seen that in some very big ways. So what have we seen? We've performed many of these types of analyses in many different sectors, and we've only found one time where we didn't find significant room for improvement. So about 9 times out of 10, we find errors in claim emergence and or overstated CPUs, and often grossly overstated. And that results in many optimization opportunities which just weren't known. The other 10% of the time, we find errors in claim emergence or understated CPU, resulting in under-reserved programs. And we've had 2 that we found that were each over $90 million underfunded. When when we find them like that, I send the head of our warranty analytics in to deliver those findings. And then I come in later after all the flack's been shot. But one of them actually it was so much underfunded that the manufacturer actually got pink sheeted for a period of time. And that was one of the 3 reasons. Now, again, while our examples are focused on extended warranty programs, the analytic techniques that we're going to discuss apply equally to manufacturer's warranty, especially where the manufacturer's warranty is longer than a 1-year term or includes features and benefits in addition to the traditional break fix. So think of, many of the warranties in the sectors that we deal are not 1 year anymore. They might be 1 year on some of it, might be 3 years on other parts, might be 3 years bumper to bumper, might be a powertrain warranty that's 560, all sorts of opportunities that exist. So it's really challenging to get accurate CPU and claim emergence forecasts from a lot of reasons. But for example, on new products, you may only have several months of field data, but you have to extrapolate a failure out for many months or years. Parts and labor costs may constantly change, as well as product mix and technology. You have products that have seasonal usage pattern due to climate change or specific geographies. And what we've seen over the last 1.5 years is unprecedented. The COVID-19 has caused a lot of changes to claim emergence, to claim frequency, and so on. And so how do you use that? How do you take a look at the historical perspective over the last 18 months and say, what does that mean for the future? And there are modeling techniques and ways to kind of not overreact or underreact to that. Some other reasons that it's challenging is that the traditional survival analysis methods like Kaplan-Meier, Weibull, Cox regression provide a good starting point for predicting claim frequency, but they don't address the cost or severity of an event. They don't address recurrent events or the same event happening multiple times. And that's used a lot in social science and public health studies, but there's also significant application of warranty. It's difficult. They don't address extrapolation or complex claim emergence, and many of the sectors in which we deal have really complex claim emergence that requires other modeling techniques. So a combination of multiple types of models is really the best way to ensure the modeling. And the reason I put this little cartoon out there is I've got advanced degrees in econometrics and quantitative methods, and our analysts have forgotten more than I ever knew. They are just wicked smart. They don't ever, kind of stand on their laurels and use the traditional techniques. They are constantly pushing the envelope to find new modeling methods and techniques that work. And it makes my job kind of easy because they can even make me look smart. And those of you who know me know that that's no small task. So we can go through this at a detailed discussion at your request, but we use several different and client-specific modeling techniques to determine the most accurate methods to forecast CPU claim emergence, ultimate runoff, and so on. One of the reasons that we like to forecast total claims and divide it by total premium is because every single update we do is therefore an ultimate runoff forecast. And so our clients book to our numbers on every single update we do, and then we're updating either on a monthly or quarterly cadence. And so nothing ever spirals out of control. Tweaks are made, modifications are made, new information is brought into the models and the forecast, and there are no surprises. We also partner with professors and leading universities to ensure that our models use the latest research, because there are new mathematical techniques that are applicable to the warranty forecasting work that we're doing. And those professors have been very helpful to us. And we tend to recruit at those schools. And we've had really good experience in recruiting at those schools and finding analysts that are not just book smart, but they're great business people. They get it, they understand it, they peel the layers back, they find every way they can to make sure that they're more accurate, because ultimately they're on the hook, as our company is, for these accurate forecasts. And we're talking oftentimes millions and millions of dollars. So if you ask the question in your company, how do we calculate reserves or cost per unit? And you get answers like loss triangles, chain ladder, augmented chain ladder, or any of the starting point methods that we've mentioned, you really owe it to your business to explore alternative methods because they can be game changers. I'm going to take a breath and see if any questions up to this point. Okay, we'll pause at the end. Now, one of the things as we get into this case study, I want to preface this by saying I don't want anyone on this call today to come away thinking that insurance carriers are the bad guys. They are not. They perform great services for our industry, and we're partnered with some of the best ones in the industry, including several that are on this call today. And as we kind of talk about the mistakes that were made, I do want to point out that the mistakes that were made were not by anyone that's on this call today. And I just want to make sure that everyone understands that. That said, not all the carriers are created equal. And we actually do risk oversight for some of the insurance carriers, carriers for whom we're partnered, with whom we're partnered. Now, Kelly asked that I do a setup on their situation and kind of walk through some things for you. And then I will take a breath and she can share her experiences with you. So we first became partnered with Polaris in 2010 for point of sale marketing of their Polaris protection plan. Now, at that time, both the administration of the claims and the risk were outsourced entirely to a vertically integrated TPA insurance carrier. In 2012, the carrier conducted an actuarial review and it led to a large proposed rate increase and other punitive measures. And we can't share with you the size of the premium rate increase, but it was several $1 million annually. They had an additional surcharge on selective vehicles. They wanted to double the deductible. There was a plan to fulfill the claims with generic parts, and there were other miscellaneous exclusions. And so what happened is because it wasn't accurately measured as they went on, and then they came up and said it's underfunded, those prospective pricing and other measures are often not effective because it could kill the program. It could make it so that the go forward program is so unsellable that they'll never claw back what they saw as the gap. At the time, Polaris wasn't in a position to absorb such a dramatic rate increase and other measures. And they couldn't pass those kind of increases and changes onto the dealers because the dealers would likely opt for third-party service plans. So Kelly called me in 2012 in the third quarter, and I remember exactly where I was when she called me on my cell phone, and that was almost 10 years ago. She's a professional and she never ever panics, but I could tell and I can remember the seriousness in her voice when she related what was going on and asked if we could help her determine if this was real. So we performed an analysis and uncovered several errors. Resulted primarily from the typical methods for evaluating loss ratios, the so-called actuarial methods. A lot of loss triangle work, that sort of thing. Invalid assumptions about the warranty lengths and earning curves and failure to recognize changes in product mix and performance. So relying too heavily on the historical perspective of the data as opposed to what was current and what was new. I want to point out one of the errors. And again, a lot of words on this slide, but this is important to understand because this happens, this is at the foundation of the 90% of where we see over-reserved and incorrect CPU forecasts. So in simple terms, according to FASB and GAAP, premium can be earned either pro rata or according to known claim emergence. Claims seldom emerge on a pro rata basis, but the actuaries often earn premium either pro rata or modified pro rata. In this case, the actuary was earning premium on a modified pro rata schedule that was slightly skewed toward front-loaded claim emergence, but not nearly enough. And so the loss ratio, or the claims divided by premium, as this actuarial team was calculating, it was incurred claims divided by earned premium. And as you can see in this case, I'll go to the next slide, at 50% earned on a 48-month contract, if there's front-loaded claim emergence and 75% of the claims that incurred in the first half of the service contract, but they'd only earn 50% of the premium, they're going to show 150% loss ratio. But you'd never know it until you either got an accurate analysis done or until you quit doing business with them, because you've got new contracts coming on at approximately the same rate as old contracts are earning off. And so give or take, it's always about 50% earned. They'd never know. So we found errors in premium earning patterns, but also when to start earning the premium, incorrect assumptions on future parts and labor costs, no credit for engineering changes that resulted in lower claim frequency, and two key categories and other errors. And so I'm about to turn it over to Kelly, but we first went on site to Minneapolis and presented our findings to Polaris, and then I'll let Kelly go from here.
Sure. You know, I think this is a difficult story in terms of, you know, none of us are as technical as after and as insurers. And when you're running a business and you have many different priorities and you don't have all the data points and the information you need to make the decisions, and you're given one data point, which generally is the loss ratio, and it's not, you know, 2 + 2 does not equal 5, and you're looking at it and you can't make sense of it because you've never looked at this data set before. And someone's saying, okay, well, your loss ratio could be consistent for 4 quarters, and then you show up to a loss review in the 5th quarter, it doesn't make sense. Your loss ratio is now skyrocketed, and you know in your gut, and you know based upon quality and other data points that this doesn't make sense, but you don't have the information or years of experience behind you to say that's wrong. I know it's wrong, but I can't tell you why. And I think that's where reaching out to Paul and his team just helped. And I can't say always that, you know, we didn't agree with the insurance carrier necessarily on how to earn premium, right? That they had been earning it based on pro rata or however they had decided to earn it. I didn't necessarily have the experience to say, how are you building my forecasts? And should we agree upon that to begin with? And how are, you know, those are questions I would have had to have had many years of experience to sit down and go product by product and look at earnings curves. And it would take me years to build that data set and information. And I had the understanding that that would have been done for me. So just having the experience of a company like After who has that knowledge and has looked into that information in the past so that all the data points could align for all parties makes the most sense. And then once I learned how it works, right? I mean, we think we've sat through this presentation now for 30 minutes and I look at it again and it's confusing. Although all my models have been built now and they all make sense and I can tweak them and adjust them. And it's very easy to run the business at this point, but it has taken many years to get to that point. So, and I think you can flip the slide, Paul. So at the end of the day, when you're looking, and if you are looking to do this type of business, and the reason why we did it at Polaris is because we wanted control over our own destiny. It's hard to rely on third parties, and they're doing the best they can, but we know that we can do it better, right? First off, we know our product better than any other third company out there. We already adjudicate our own claims for our manufacturer's warranty in-house. So it only makes sense that we would continue to do this for an extended warranty. And then with accurate analytics and risk oversight, we just felt like if we understood it, we could do it ourselves, and why not? So with all of this new information and we decided to present this journey to our senior management and say, I think we can do this. And it might be a long journey to do it conservatively, but I think it's best to bring this business in-house, but it's going to take some time. And so after that conversation in 2012 in aligning after and our TPA all together to right size the business the way we all felt it should run, we then decided to move forward with a long-term plan. And it did take 8 years to get us where we are today, which is fully operational and running in-house through a captive and a warranty company. And it was phase by phase. We started by just adjudicating claims. Phase number 1, like, let's just start there and still continue to outsource the risk and do that. And then we started bringing our promotional business in-house, which and adjudicating, basically taking that risk on and running that through the captive. That does not need as much regulatory and compliance oversight as the dealer sold program would. So that was the next logical step. And then we just kept taking baby steps until finally we opened up a warranty company. And it's not just one warranty company, it's several warranty companies. And then you need to be licensed to sell extended warranties in different states. And so it's a lot of work, but the end result is we know our product, we know our losses by model, we understand the business way better, and we're in complete control of the entire program. We want to be marketable. We want our dealers to be profitable. We want our customers to have the best experience. And that's what running this program in-house does for us. And with After's help and risk oversight, where we don't have to worry about and have the whole analytical team sitting with us, we can ask the hard questions and have somebody else, a third party, just doing the oversight for us, is very helpful. And that's pretty much where we're at today. I can answer detailed questions. I would say the process is is long. I think you could do it faster, but it's a lot of different steps to get there. And in needing outsourced legal and compliance and in different moving pieces with it, but with good partners, you can do it pretty easily.